Welcome. You're watching Talking Point. I'm Tamanna Inamdar, and we have a very special guest today. Great time actually to speak to Sunil Koul, Asia Pacific Portfolio Strategy, Goldman Sachs, because a lot of the conversation we're having right now across the world and in India as well is focused on what is happening globally. And even though we are now a country with a huge force in the context of domestic investors, yes, what Jerome Powell says at Jackson Hole does matter. So with that setup, Sunil, great to speak with you on NDTV Profit, and absolute pleasure to have you on the show and get your view on what's happening in emerging markets. But let's talk about India as well. So let's start with the foreign investment outlook for India. We've been seeing outflows. Your recent report highlights that India is one of the two emerging markets, I think, if I recall, that are seeing foreign investor outflows. Can you lay out for us why you think that is, and do you see this as a persisting trend?
Sure, Tamanna. First of all, thanks for being on the show. I would say, look, I think in terms of the foreign flows, you're right. Like India has been seeing foreign outflows. I think the month to date we have already seen about 2 billion foreign selling from the July peak. It's probably around 3 billion selling. But I think, as you mentioned, we also have to look at the broader context in terms of what's happening around the globe. So obviously, we had a lot of volatility in the markets in July and August. So if you look across the region in Asia, but also broadly in the EM, we have seen close to 18 billion selling in the markets. And so I think India was just a part of the global risk off. What we are hearing also from the clients is that even though markets have recovered in August, people are still kind of de-risking across the regions. We are not seeing it just in India, but also in Taiwan, in Korea, in China, onshore markets as well. So I think it's a part of a global sell-off. And to be fair, I think India, in fact, has been outperforming in performance terms, both in July and August in general. And I think that just shows India's resilience in the face of the global sell-off. And so I wouldn't sort of read too much into the global sort of outflows in India. It's just the broader de-risking in the region, which India is also a part of.
Okay, fair enough. So it's part of the bigger picture. But then two things that you hear very often, and not only in the context of foreign investors, to be honest, but yeah, in their context as well, is about some concern about valuations. And now we have sort of become a market, and like I mentioned in my opening comments, driven by domestic investor liquidity as well.
Of course.
Is there a sense of discomfort there in your conversations?
There is. I mean, in fact, I think valuation remains the topmost, I think, concern from clients in terms of India's sort of story. I think the great fundamental story is pretty well known, but I think the greatest pushback we continue to see around valuations. But I would say a couple of things on that, Tamanna. One, I think if you just look at the aggregate market, Nifty is trading at roughly around 21 times forward earnings. MSCI India is a bigger index and has a bit of mid caps in there as well, so it trades a bit more expensive, around 23 times forward. But if you look at what we think the fair value for Indian equities is, based on the domestic growth outlook, global growth outlook, the fund flow situation, we think around sort of 20 times forward earnings is a fair multiple. And so I would put India's valuations as richer, but not sort of in the overvalued territory if you look at in that context. I think it's also important to look at India's valuations relative to everything else, particularly emerging market or the region in Asia. So India is right now trading at 80% premium to the region. So the last 5 years average is around 50%, but the peak was around 100% plus. So again, I think if you look at that metric, it will tell you that India is kind of trading like a growth stock where foreign investors are giving it a premium, but it's not super expensive from that standpoint. And I think the last point I would make is that you also have to look at the valuations in the context of the market performance and underlying earnings, right? So in MSCI India terms, the market was up 20%. 8 months into the year, we are another up 20%. So the market has had like 40% plus returns in the last 20 months or so. But if you disaggregate that 40% returns into how much came in from multiple expansion versus how much came in from underlying earnings, almost 30 percentage points and a little bit more of that has come in from underlying earnings. So the multiple expansion has been only in sort of single digits. And so if you came into 2023, India was trading at MSCI India was trading at 23 times multiple. Today is 23 and a change, 23 and a half, right? So in aggregate, the multiple hasn't expanded. Obviously, different sectors have moved a lot, but a lot of the underlying move has been driven by underlying earnings, which we think is obviously a good thing to have, and which is why we are positive on the market.
Um, Definitely positive on the market, and perhaps another factor is the MSCI rebalancing, which will now kick in. And you know, your report talks about it, Sunil, where you say that you expect the largest passive inflows coming into India because of that rebalancing, upward of 4.3 billion USD. Does that then spur active inflows as well?
Um, Probably not on the back of the rebalancing, because the rebalancing is kind of more a technical event. It happens at the end of the month. The reason India is getting sort of 4 billion plus inflows is because you have 7 stocks that are coming into the index in MSCI India, and so the number goes from 140 plus stocks to nearly 150 stocks there. And so the flow is very concentrated um, in these names that are getting included. And also you have the largest largest private bank where the foreign inclusion factor was increased, so that's also driving a lot of flows. So I think it's very kind of concentrated in a few stocks, and largely kind of technical in nature, which is why, because of the index rebalancing, the passive will have to do it. But we don't think it necessarily means that active will need to follow. But I think the bigger picture here, Tamanna, is that, as you show in the picture, that India's weight in the emerging market is going to increase, or MSCI index is going to increase. So from 19% or 19.4, as you show in the table, it's going to be close to 20% of MSCI EM. And China is at 22, and so India is kind of a close number 2 in terms of the weight. So that means that it would be the second largest market in EM and very close to China. And so it over time we think that will encourage more active investors to come in and increase exposure into the market.
Yeah, that's a big one. India will be the second largest market in EM and closing in on China. Now, in your report too, and I've cherry picked the India specific ones, Sunil, if you will allow me, because relevant to our viewers. Two charts that really stood out for me. One is that retail sentiment is above historical levels for India. You also talk about how risk appetite seems to be waning. Now, contextualize that to us. I'm, of course, reading it together. That may not necessarily be the right way to do it, but do contextualize it for us.
Yeah, I mean, look, I think the risk appetite sort of waning is again sort of something we are seeing across the region. As I said, I think in general for Asia, for emerging market, when you talk to clients, it's very clear that obviously markets have been super volatile in the last couple of months. We also have, as you started the show with, sort of Fed policy coming in, Chairman Powell comments coming up, but more importantly, you have U.S. elections coming in in November. So I think the general sense is that markets are likely to remain volatile across the globe, and so people are generally kind of de-risking into the event, which is why we kind of are seeing risk appetite barometers, not just in India but pretty much across the board at low levels. And a large part of that is because of the foreign selling we just started the show with. But I think domestic flows is obviously a separate story, which is what has been holding up the market, as we know. I mean, to ask Tamanna, that seems like a structural trend, because as we know, India's household balance sheet exposures are still pretty low compared to sort of regional peers. 6-7% of the household balance sheets are in equity markets. In US that's north of 40%. In Europe that's 20 to 30%. Even in Asia, I think the average is more like 15%. So we think this is kind of a structural trend and it has more room to grow. And I think therefore domestic flows will continue to support the market here. In addition to that, you also got mutual funds sitting on decent cash balances, around 4% of the AUM, which in absolute terms is north of 10 billion US dollars. So you got sort of more money coming in from retail in terms of SIPs, which are hitting every month new highs. And then you also got mutual funds by themselves sitting on large amounts of cash balances, which we think will continue to support the market here. I think what it means is that in these environments of global kind of risk off, India will continue to be sort of outperforming on a relative basis, even if directionally it may be kind of more flatlining or go down, but it will still be outperforming the emerging markets, broadly speaking, over the next few months.
Okay, you've also talked about, Sunil, about how there is a lot of global money sitting which is underweight on India. So now we've talked about various things, right? It's a larger picture why you are seeing FII outflows. MSCI rebalancing might not really move the needle. I'm trying to understand what are the factors that would change that outlook. Yes, the domestic industry is strong, etc., or the domestic retail flows are strong, etc. What would change the outlook? Because it seems unlikely there is going to be any big change in valuation or the valuation picture anytime soon.
No, I think that's a fair question. I would say, look, I think the fact that the market is becoming bigger, economy is becoming bigger, and you got kind of liquidity improving in the market, I think that should get more investors into the market. And so obviously it's kind of already sort of a 4 trillion economy and an equity market, and liquidity, which was always concentrated in the top kind of 50 odd stocks, or Nifty 50 is obviously broadening out. And the way we started the show, I think MSCI India is a good example of that. Sort of a few years back, it used to be only have 60, 70 stocks. Today, you are double of that index, which has both a market cap and a liquidity criteria. So you're kind of seeing market broadening out, and we are also seeing people or foreign investors taking risk beyond the top stock. So I think that's important, and I think that's a trend that would continue. We are also seeing more and more funds that are having sort of non-China mandates, Asia ex-China, EM ex-China mandates, and in that sort of scenario, India sort of is almost 25% plus of the mandate. So I think you're also seeing that trend play out. I think the global funds being underweight India is something which is true for pretty much many markets in the region and EM in general, because many of these global funds tend to have a DM bias in their allocations, and part of that comes in from sort of home country bias as well, or where they are sort of domiciled. A large part of them are in Europe or actually in US. So it's not specific to India, but what we are seeing is that when a market becomes larger in indices and with decent liquidity and size, you typically start to see allocations improve. So we are therefore hopeful that given the superior fundamental story and the market becoming much more liquid and bigger, you should see foreign money sort of coming back into India. And I think as we see from the foreign allocations or foreign ownership data, I mean, the foreign ownership is at 11-year low, and mutual fund allocations are still conservative. So we think there's a lot of room for allocations to improve here,
Yeah,
if earnings continue to support. Yeah.
If earnings continue to support, no, fair point. There is room for growth, absolutely. Where is that growth, or when that growth comes from, is the question. You know, another factor that Indian investors and our viewers right now are focusing on and are looking at is what's happening globally, what's happening with the Fed, the whole rate cut story. So we've had a couple of data points in the last few days, and it's current and new. So great to get your view on it. One, I would say, is the Fed minutes, which reiterated the September rate cut hope. The other is the jobs data that has come in two sets of it, the weekly jobs numbers and also the downward revision of jobs last year. How do you place all of these together? Because it's a picture which is still quite muddy in terms of what's happening with the US economy.
No, look, I mean, uh, to sort of lay out our view there, I mean, our core view on U.S. economy is that the U.S. economy will continue to sort of expand rather than a recession scenario. So we have U.S. economy growing at sort of 2 to 2.5% run rate over the next few quarters or over the second half of the year. So we think that the U.S. economy is still strong. Obviously, some conflicting data points, as you mentioned, Tamanna. Obviously, we had the weak sort of we had the employment numbers picking up. We had the weak jobs report. I think our sense was that part of that was also coming in from more supply side in terms of kind of migrant laborers and all of that, as opposed to kind of a demand side weakness in the labor market data. And in fact, I think the latest U.S. economy data that came out in terms of retail sales was actually pretty decent. And so overall, I think we do think that even though recession risks have increased, we have increased our subjective probability of recession from 15% to 20%, but we still think that overall the economy is in a decent shape. In terms of the Chair Powell's comment, I think they will be important because in more more likely they will probably continue to reiterate the fact that disinflation trends are in place, but the labor market seems to be weaker, which is sort of consistent with our overall rate cut view, which is that Fed will go in September and they will have 3 rate cuts this year, September, November, and December. I think the market is pricing close to 4 rate cuts or 100 basis points cumulative this year. Uh, so we are at 3 cuts, but I think the Chair Powell comments would probably be consistent with the 3 cut scenario, and then we have a quarterly path of 25 basis points rate cuts next year with the terminal rate of 3 to 325 for US.
Wondering, what are you looking out for, Sunil, from the speech, which we will see, of course, India time later tonight, from Chair Powell? I mean, is he really likely to give that much clarity on what could happen in September?
Look, I think if Chair Powell, as I said, reiterates the fact that disinflationary trends are in place, which means there is kind of room to sort of cut rates, and at the same time say that there is some weakness in the labor markets. I think the combination of both of those should be a cue for the market that the rate cuts are coming. I think there is an outside case that it could be even more dovish to the extent that if he says that the rates are too high, obviously that could be an indication that the rate cuts are imminent. But our sense is that even if they broadly reiterate the message that you have inflation coming down and you have some weakness in the data, and sort of that should be a signal for the market that rate cuts are imminent. And the market, in fact, is obviously pricing in more than 100% sort of chance for a rate cut in September, and we think in a base case that's more likely to happen. The other thing in terms of rate cuts and equity markets, the linkage, what's important, Tamana, is that, I mean, if you look at the Fed rate cut cycles, because we get this question from investors often, is that how does markets react to Fed cuts, Asia or EM or India for that matter? I think if you go back, there are sort of 8 Fed rate cut cycles going back to early 90s. 4 of them have ended up in recession over the next 12 months. 4 of them have ended in a non-recessionary sort of Fed rate cuts. And it's very clear that if there is a recession scenario, despite Fed cuts, the market doesn't do as well. But in a non-recessionary Fed cut environment, that's generally good for risk assets, good for sort of Asia and emerging market equities, including India, and that should kind of spur inflow. So in our base case, as I mentioned, if we are right in terms of the fact that U.S. economy will continue to expand, and you get Fed cuts starting September, I think that should be better for risk sentiment overall.
And for India as well, by extension. All right, we have much more to unpack. I have to take a very small break, but Sunil Koul also talked about US elections as a factor. We'll talk more about that after the break. Going into the break, let's listen in to what Kamala Harris said. That's important because she has now officially accepted the Democratic presidential nomination at the DNC. That's their conference, and has invited voters to chart a way forward. Listen into what she said. We take a break and we come right back.
On behalf of Americans like the people I grew up with, people who work hard, chase their dreams, and look out for one another, on behalf of everyone whose story could only be written in the greatest nation on earth, I accept your nomination to be President of the United States of America.
You know, we've been talking about what are the big factors to watch out for that will impact markets, especially emerging markets like India, in the next few months. And I think, Sunil, we would really be missing out if we didn't talk about the US elections. Now, we just played out before we went into the break the comment from Kamala Harris. So the competition or the fight is clearly Trump versus Harris. Still 2.5 months to go, and the way things are moving, you don't know how it will work out. What is the best and worst case scenario in either way in terms of US markets, as well as then how that trickles down to emerging markets like India?
Yeah, look, I mean, as you said, Taman, I mean, a lot could happen in the next 2.5 months. I mean, the prediction markets have sort of moved all across the place in the last 2 months since sort of Biden pre-debate versus now Harris coming in, right? And so depending on, I mean, so if you look at the scenarios, obviously there is sort of Republican presidency versus the Democratic presidency, and then there is kind of the divided House versus the sweep. And so there are kind of four scenarios in between, and the outcome for the asset markets would be pretty different depending on what comes out. And obviously there is a lot of uncertainty, as I said, at the moment. But I think what's true is that even though the polls are predicting a tight race, there will continue to be news flow around the US elections over the next 2 months plus, which is why I think we have taken a generally a sort of more defensive and cautious view on the markets. A lot of the client questions we are getting around is more around the potential impact of tariffs, and if they come through, which markets will be more impacted, which markets will be less impacted. I think that's where people are kind of running some scenarios at the moment. What I would say, I think in context to India, I think India is still a market where the spillovers from the US election should be fairly sort of limited or contained, right? And so I think when people are kind of looking across the emerging market and thinking about sort of potential tariffs, uh, I mean, you want to be in the markets which are largely kind of domestic in nature, which are largely kind of isolated from these risks, and potentially have lower risk of tariffs if they come through. And so I think India kind of checks those boxes along with some of the other more defensive pockets in the EM. So it also therefore is a decent sort of defensive hiding spot for the next few months in that context. And I think there is a fair degree of agreement within client community on that as well. So I would say, look, I think it will probably keep markets volatile across the emerging markets in general. I mean, China is a big part, so are Korea, Taiwan, which might be impacted. Obviously, Mexico and LATAM markets are also in 2018-19 were impacted from all of that. So there are a lot of the EM markets which probably are more impacted from this event. But our sense is that India has relatively less sensitivity to these risks, and so it should hold up pretty resilient.
So even
over the next few months.
geopolitically, we've seen a Trump administration or Republic president or a Democratic president pretty even-handed as far as India is concerned. But
That's right.
at this point, the perception seems to be that Trump perhaps good for business, good for markets, good for India. Is that necessarily the case? I just wanted to understand what the view is there. Is Kamala better for India or Trump?
Look, I mean, we don't have strong views in terms of the actual outcome of the elections, but I would say in terms of a different scenario, I mentioned, I think clients do think that in case of a Republican presidency, that probably means lower tax rates. That probably means sort of more fiscal sort of push, which is good for growth, which should be good for sort of asset markets in general. Whereas if you see a Democratic presidency, and again depends on whether it's a divided House versus a sweep in terms of what they can pass or what they can't pass. But in general, that means probably higher taxes, corporate tax rates. I mean, the Harris administration has talked about that, and that particularly may not be so great for asset markets. So again, we need to see how this plays out. But I think if there is one thing we could be certain over the next couple of months is that market volatility will probably continue to pick up, which has been the case in the last couple of months.
Okay, just a last point, Sunil, and I know, of course, you won't talk stocks, etc. But just want to understand your view that from an Indian equities perspective, all things considered, valuations, company result performance, etc. What are the areas which you see with some interest right now and are constructive on?
Look, I think we still like the domestic sectors in India, and so we are overweight things like autos. That has done very well for us. I mean, but that's a position we still hold. We are overweight industrials on the general sort of continued focus from government on infrastructure, and obviously that got reiterated in the budget. We still like some of the defensive pockets, including telcos with the tariff hikes. So we do like insurance within the financials as well as a defensive place where a lot of the regulatory headwinds are behind us. So I think in general, our preference continues to be kind of domestic sectors or some of the external facing sectors. And then we also like a lot of the thematic pockets in the market, including the themes of sort of agri and allied industries, the theme of clean energy, or the energy security in general. Defense is an area which we have been emphasizing. And this sort of broader theme of sort of make in India, PLIs, that's also something we have been reiterating. So I think beyond the headline index, where the broad view remains that the market still goes higher in 12 months, on the back of underlying earnings, and we have a 26,000 target on Nifty. I think beneath the headline index, I think there are a lot of these thematic pockets which we think will continue to have stronger interest over a medium term.
Okay. Thank you so much, Sunil. It's been an absolute pleasure speaking with you on the show, and thank you for all those in-depth responses. Interesting views coming in from Goldman Sachs, especially some of the sectors that they are constructive on, industrials and auto on top of that list as well. That's all the time we have on this edition of Talking Point. Thank you so much for tuning in. We'll take a very quick break, but stay tuned. A lot more coming up on the other side on NDTV Profit.